Hey everyone, welcome back to the Web3 Daily. Today, the market is in a state of calm after a massive shakeout. So, is this the perfect time to buy the dip? Or is it just the quiet before another storm? Let's break it down in a nutshell. After a wild roller coaster ride, the market has finally found some stable ground. But you've probably noticed that trading volume has absolutely cratered down by more than half. When I saw that number, my first reaction wasn't panic. It actually felt like a healthy sign. What does it mean? It means all those high-leverage speculators have pretty much been wiped out. The market is a lot cleaner now, setting the stage for a more solid rally down the road. Let's look at the big players. Bitcoin is in a tug-of-war between $107,000 and $112,000, with $110,000 acting as a key psychological support level. The bulls and bears are at a total stalemate. But here's the thing. Around the $104,000 mark, we are already seeing signs of big money quietly accumulating. Looks like the value investors are making their move. Ethereum is in a similar spot, consolidating between $3,900 and $4,100. But there's a really interesting detail here. While the price hasn't made any huge moves, its futures open interest has actually climbed by 8.2% against the trend. This could be a sign that new speculative interest is quietly building up. People are still really bullish on the future of the Ethereum ecosystem. Of course, there's always an outlier that doesn't play by the rules. Take the token enzyme, MLN, for example. It more than doubled in a single day. A real bright spot in a sea of red. It's definitely catching people's attention. Alright, let's dive into the topic that's absolutely blowing up the internet today. Elon Musk's X platform is pulling another one of its stunts, officially launching something called the Handle Marketplace. Simply put, they're now openly auctioning off usernames that have been inactive for a long time. The moment this dropped, the whole community just exploded. I mean, think about it. Premium short handles like @pizza or @Tom are now up for grabs with a price tag starting at $2,500 and reportedly going up into the millions for the rarest ones. For some folks building brands and projects, this could be a golden opportunity to legitimately snag a top-tier username that's perfectly aligned with their brand. The value of that is comparable to grabbing a premium domain name back in the day. But when I first saw this news, my stomach dropped. Isn't this just a complete commodification of digital identity? We used to have a first-come, first-served spirit on social media, but now it's turning into a pay-to-play game where whoever has the deepest pockets gets the best digital real estate. This completely shatters the spirit of fairness in the community. What really puts me on high alert, though, is how this could become a new arsenal for scammers. Anyone in our circle knows X is already a hotbed for crypto scams. Countless fraudulent projects get by just by buying a blue checkmark and running some ads to look official and trick newcomers. And now they can just buy a username that looks established and incredibly deceptive, like grabbing a handle like @Binance. Imagine the damage that could do. This is without a doubt a massive threat to the security of the entire Web3 ecosystem. If you dig a little deeper, you'll see Musk is playing a very clever game here, pushing a kind of Web 2.5 strategy. He's borrowing our Web3 concepts, digital assets, scarcity, secondary markets. But at its core, it's the same old centralized Web 2 playbook. You think you're buying ownership of that handle? Wrong. You're just buying a license to use it, which the platform can revoke at any time. He's not embracing decentralization. He's co-opting the Web3 hype to monetize his centralized empire. However, there are two sides to every coin. When a massive Web 2 platform like X starts putting a multi-million-dollar price tag on a string of characters, it's also providing a huge unprecedented market education to the entire world. Digital identity is extremely valuable. Think about it. If a username controlled by a centralized platform can sell for that much, what's the potential value of the decentralized identities? We're building the ones that are truly owned by users, interoperable, and recorded on-chain. The upside is immense. So, in a way, Musk might have just done Web3 a huge favor by forcing more people to think about the true value of digital identity, which might eventually lead them right into our truly decentralized world. Alright, let's get into our first major news story of the day. And this one might be causing some sleepless nights for our friends in the UK. The British Tax Authority, HMRC, just made a massive move, sending out warning letters to 65,000 crypto investors all at once. I was floored when I saw that number, 65,000 people. That's more than double the number from last year. The signal here is crystal clear. The regulatory hammer isn't just being waved around anymore. It's coming down with precision strikes. They're now getting user transaction data directly from the major exchanges, so they know exactly who's trading and who hasn't been paying their taxes. And the letter is brutal. If they find you've been evading taxes, the penalties can be up to 100% of what you owe, or even more. In extreme cases, they can go back and audit your finances for the last 20 years. They've listed every possible taxable event, to selling for fiat, crypto to crypto swaps, even using crypto to buy things or gift it to someone. It's all taxable. But listen up, because this is just the beginning. This move by the UK is essentially a dress rehearsal for a global framework called CARF, which is set to launch in 2026. In short, nearly 70 countries and jurisdictions are creating an automatic information sharing network for crypto assets. This means if you trade on a regulated exchange anywhere in that network, your data could be automatically sent to your home country's tax authority. So the era of trying to use information gaps to avoid taxes is pretty much over. This will inevitably create a huge market for crypto tax services, and at the same time, it poses a major challenge for all decentralized protocols and non-custodial wallets. How do you maintain the spirit of decentralization while helping users navigate this new wave of global compliance? Alright, so while the UK is busy sending out tax letters, Japan is playing a completely different game on the other side of the world. They're thinking several moves ahead. Japan's top financial regulator, the FSA, is considering a revolutionary regulatory shift. They're planning to allow domestic banks to directly buy and hold crypto assets like Bitcoin and Ethereum right on their balance sheets. Now, you have to understand, under current rules, Japanese banks are strictly prohibited from buying crypto for investment purposes. The most they can do is offer custody services and other peripheral business. So, if this door opens, what does it mean? It means Japan's top-tier traditional financial system is giving crypto assets the highest possible seal of approval. In the future, banks buying and selling Bitcoin could become as normal as trading stocks or government bonds. When I saw this news, my first reaction was that Japan is making a serious play to become the crypto financial hub of Asia, and maybe even the world. They're not just passively adapting to the market, they're actively building an onshore, fully regulated, institutional-grade crypto ecosystem. Think about it. By letting their most trusted domestic banks get directly involved, they can channel a massive amount of institutional capital and high net worth money into regulated, compliant channels within their own country. With global regulations, especially in the US, still murky and places like Hong Kong making aggressive moves, Japan is playing the safety and compliance card. They're trying to use the strictest, clearest regulatory framework to attract global crypto capital that's looking for a stable policy environment. This isn't just about protecting their own investors, it's about elevating their strategic position as a top financial center in Asia. It's a brilliant strategic play. Now, this next story is, in my opinion, the most significant piece of news we're covering today, because it directly reveals where the money from Wall Street's biggest players is actually flowing. BlackRock, the world's largest asset manager, just dropped a bombshell in its third quarter holdings report for 2025. In Q3, their total crypto assets increased by $22.46 billion. But here's the kicker. The value of their Ethereum holdings skyrocketed by 262%, while their Bitcoin holdings grew by only 14.6%. That's a staggering difference. And it caused Ethereum's weight in their portfolio to jump from 6.6% at the start of the year all the way to 17.2%. I did some cross-checking. And this isn't just about the dollar value of their holdings increasing, because Ethereum's price went up. No, this was an active large-scale net buy in the market. What does this mean? It means that the investment thesis for top-tier institutions like BlackRock is evolving. They didn't just come into crypto to treat Bitcoin as digital gold, a store of value to hedge against inflation. That's a relatively passive strategy. But now, by pouring a disproportionately massive amount of new capital into Ethereum, the signal couldn't be clearer. They're no longer just focused on store of value. They're betting on Ethereum's utility as a global decentralized computing platform. It's the foundational layer for DeFi, NFTs, real-world asset tokenization, the staking economy, and all other on-chain economic activity. Ethereum is more like a productive asset that generates continuous cash flow, the digital oil that powers the entire digital economy. So, BlackRock's move is essentially a declaration to the world. The smartest money is moving beyond the simple store of value narrative and is now placing heavy bets on the future of the programmable economy and the entire Web3 ecosystem. Now let's turn to the NFT market. The former king, OpenSea, after years of being prodded by the community, has finally decided it can't sit on the sidelines any longer. They've officially announced they're launching their own platform token called SEA, expected to go live in the first quarter of 2026. The economic model they've presented sounds quite sincere. On the surface, half of the total token supply will be distributed directly to the community, and the platform is promising to use half of its initial revenue to buy back and burn SEA tokens from the secondary market to support the price. When I saw this news, my first feeling was that this is more like a defensive tokenization. As you all know, OpenSea has had a tough time in recent years, losing a huge chunk of its market share to competitors like Blur, who use the vampire attacks, that is, aggressive airdrops, to steal market share. Launching a token now is an attempt to win back users with things like staking rewards and governance rights to build a moat for themselves. But this is more like a high-stakes gamble on community trust. Why do I say that? Because OpenSea's biggest problem isn't its product or its technology, it's the sentiment of its users. The community's resentment towards their centralized nature and keeping all the profits for themselves has been building up for years, and that recent reward crate event they ran, which was supposed to build hype for the token launch, was a total disaster. Most people got rewards worth pennies, and for the few who actually won big prizes, the platform suddenly required them to complete KYC verification to claim them. This move just tanked user trust to a new low. So, whether the SEA token can succeed in the future no longer depends on how attractive its economic model is. The key is whether OpenSea can show genuine sincerity and take real action over the next year or so to repair its relationship with its core users. This is truly a high-stakes gamble, and they're betting on winning back the hearts of the people. And now for the aftershocks of this market crash. A lot of people lost money, and naturally, all eyes turned to the exchanges, especially Binance. Binance's co-founder came out and made a very important clarification about their so-called mutual aid plan. She made it crystal clear this plan is not a universal compensation program. It's not like you lose money and the platform just pays you back. It's a relief fund, and it's targeted only users whose total assets dropped by more than 30% during this downturn are eligible to apply. At the same time, she emphasized that if the losses were due to the platform's own issues, like those depegged stablecoin trading pairs from before, Binance has already covered all of those losses. But if you lost money simply because of normal intense market volatility, I'm sorry, but you have to bear that risk yourself. I think this clarification is a huge deal because it draws a very clear line in the sand for the responsibilities of centralized exchanges. Simply put, the platform is responsible for platform risk, but it won't cover your market risk. This is essentially reshaping the relationship between exchanges and their users. In the past, a lot of new users had this vague expectation that major exchanges were like nannies, obligated to protect their assets under any circumstances. His statement is meant to shatter that unrealistic fantasy. The exchange provides the infrastructure. It doesn't underwrite the success or failure of your investment decisions. This will force every one of us, as users, to strengthen our own risk management skills and stop expecting the platform to bail us out. And for our final story, I think this one is fascinating because it shows us a whole new textbook-level playbook for how Web3 technology can infiltrate top-tier traditional enterprises. The blockchain payments company Ripple just spent $1 billion to acquire a company called G-Treasury. So what does this company do? In short, it provides core financial management software to huge corporations like Fortune 500 companies. We're talking cash flow management, foreign exchange risk hedging, payment, automation. They rely on it for everything. So, do you see what Ripple just did? This is a straight-up Trojan horse strategy. Before all, Ripple was a tech vendor, knocking on the doors of banks and big companies, trying to sell them on their blockchain cross-border payment solutions. But now, by acquiring G-Treasury, Ripple is no longer the salesman outside the door. They've embedded themselves directly into the core financial workflows of the world's top companies. What's so brilliant about this move? The biggest barrier for enterprises adopting new technology is the cost and risk of integrating it with their existing systems. Ripple's solution is to say, I'm not going to force a new system on you from the outside anymore. I'm just going to buy the old system that you already use and deeply depend on every single day. Then, under the hood of this familiar and trusted software interface, They can gradually and seamlessly integrate their own blockchain settlement network and digital asset capabilities. Think about it from the perspective of a corporate CFO. In the future, adopting Ripple's technology won't feel like a risky, uncertain revolution. It'll feel more like a smooth, value-added software upgrade. This model of implanting technology by acquiring existing infrastructure is, in essence, a shift from the narrative of crypto as an asset to crypto as underlying infrastructure. It points the way for all other Web3 projects aiming for enterprise adoption. Instead of building a user ecosystem from scratch, maybe it's smarter to just buy the highway that leads directly to the users. Alright, that's all for today's Web3 Daily Report. If you found this helpful, be sure to hit that like button to show your support. Every day, we sift through the Web3 world to bring you the most critical information, the news that's closest to the money. We hope that by breaking down these key stories, we can help you make more rational and informed decisions on your Web3 investment journey. Also, I've dropped some exclusive registration links for major exchanges in the comments section below. These are special high rebate deals we've secured for our viewers, and we hope they can help you save on some costs along your investment path. Let's all stay rational, move forward steadily, and get rich slowly together in the world of Web3. May all of your crypto assets grow steadily. We'll see you tomorrow.